Hi, Steve Van Metre, and welcome to your Wednesday night premiere, where we take about 15 minutes every Monday and Wednesday night to try to make sense of markets that are completely irrational. It's just beyond me what investors are thinking. Today, the S&P 500 made a new all-time closing high, along with the NASDAQ 100, only leaving the Dow Jones Industrials behind because Boeing took a big loss. No surprise, the 737 MAX is grounded, likely to be grounded another quarter, but investors don't seem to be bothered by that. In fact, for all we know, the plane's going to be grounded through the end of the year. We just don't know. In Caterpillar, they missed earnings and their outlook wasn't good, but investors don't care. They just don't care. Let me put this in perspective. In case you haven't heard, Chevrolet's coming out with a new Corvette, a mid-engine Corvette, and there's just a lot of excitement about how cool it is, and people are talking online how so many people are going to buy it. Now imagine for a moment that I was a Chevrolet dealer and I was going to sell the new Corvette, and I put an ad out that said, I will sell you as many Corvettes as you want, and I guarantee you I will charge you more than any other dealership in this country by far. So whatever is the highest price you can find, you call me and I will charge you more. Now, do you think I'd have a lot of business? No, I don't really think so. I'm sure I'd have some, because obviously I would have inventory because no one would buy cars from me. So someone would want one and be willing to pay. When you put it in frame of a stock market and say, hey, everybody, you can now buy stocks at the all-time price high, while the Asian and European economies are slowing down. Germany's in a recession, even though they won't officially admit it. The data's not there yet, but based on the factory data, they're in a recession. And yet this is your chance to pay more for a share of stock than you've ever had in your life. You would think that people might say, you know, that may not be such a good idea. And yet they're lining up to throw their money at the market. Isn't that interesting? The content of this video is provided as educational information only, is not intended to provide investment or other advice. It shows not to be construed as a recommendation or solicitation by selling security, financial product, instrument, or to participate in any particular trade strategy. This video is prepared by Steven Van Metre on personal capacity. Opinions expressed in the video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. Now, one of my clients and I like to discuss this occasionally when I see him, and we talk about the difference between earnings and profits. So people are giddy about earnings. Oh my God, look how much that company made in earnings. Look, earnings don't matter. In the end of the day, it's profits that matter, and profits are declining. You know, let's say that my company made, $1 trillion of earnings. We brought in so much money, $1 trillion. But if it cost me $1.5 trillion to make it, who's the fool? Yeah. But people think, man, he's only taking a $500 billion loss. Well, sure, you'd be able to recover that in a couple quarters and then some. No. Look, profits in the end of the day is all that matters. Profits have been flat for over a year, and they've started to decline despite higher earnings. So companies are generating more revenue and making less money. And yet investor response is, woohoo, take more of my money, please. I want to pay a premium. Can you only imagine if auto dealers could get customers to pay the absolute highest price in the country on any given day for a car? Do you know how happy they'd be? No one would buy cars from them. But yet, people just can't get enough of stocks. All right, so the purpose of today's video is to talk about investor psychology. Our focus is going to be on Apple. Again, I do not own any Apple shares. I've never owned any Apple shares. And I'm 99% sure I don't even own any Apple products. So I have no bias as far as to pump or demote the stock in either direction. We're also going to look at crude oil because the charting patterns are the same. But first, let's take a look at market liquidity according to the NASDAQ McClellan Summation Index. Remember, when it breaks zero, it usually has a bad sign. Well, markets are, at least of the S&P and NASDAQ, back marginally at all-time highs. And the liquidity index is saying that there isn't much liquidity in this market. It's actually rolled over. and it looks like it's heading lower. And that, again, because this last dip didn't do anything, a second dip will most likely have quite a bit of an effect. Now, before we jump into the Apple chart, I've got to make sure we can see what we need to see. We've got to go back and reference the Wyckoff schematics of distribution. And we're going to focus on this symmetrical triangle because you're going to see that both in Apple and in crude oil. Again, it's not a bias against Apple or for Apple. If I'd seen it in some other stock, we would be using their name. So what goes on in these distribution patterns is big players, smart money, could be large investment managers, institutional managers, generally not hedge funds. They have large blocks of stocks they want to get rid of. And typically it's corporate executives, mainly executives at the company that we're referring to. So they want to sell. So the public is very euphoric, and the public drives prices up. And then the big players sell, and they drive the stock back down. But they notice as they're driving it down that the public is still very enthusiastic, even though they paid prices up here, and they see it coming down and they want to buy more. So they turn around and the public buys some more, and then the big players push it down, and then the public buys more and the big players push it down. And the reason you'll notice this narrows is because the amount of ammunition or money that the public has to bid up stocks gets weaker and weaker. Hence why it's a rising side of the triangle. Now you might say, well, the big players are running out of money too. Trust me, the big players always have more money. You will not see corporate executives fully liquidate their positions. They're just trying to get out as much as they can. So they're coming in and selling at lower and lower levels, and then at some point they overwhelm all of the buyers, and this breaks down. Now, sometimes symmetrical triangles do break higher. It's not always a distribution pattern, but most of the time it is. Now, when it breaks upwards, it can go shoot straight higher, and when it breaks down, it can go a lot lower really fast. So now that we've looked at those, let's go take a look at some charts. So let's start with Apple, because it starts with an A. So you'll notice I've drawn a couple lines here, and I'll make them a little bit bigger just so in case you can't see them. So there you are. You see these two purple lines? We are creating a symmetrical triangle. I'm just going to double check, make sure we're on the same screen together. Perfect. Last thing I want to do is talk while you can't see it. So here you see a symmetrical triangle forming. What's happening is you see big players selling stock down, and then you see the public bidding prices up. Then you see prices go down and the public bidding them back up. And we're at a very interesting inflection point, because if I zoom in over the 10-day view, you can see it's just crossed right over that line. And if we go to the daily view, we can see due to Facebook earnings, people got excited about Apple and drove their stock higher. Now, there's a couple of headwinds facing Apple stock. They will not have a 5G phone out until next year, and global shipments of cell phones are down dramatically. Now, Apple does not report earnings until Tuesday. I do not have any inside information as to their stock. So again, I'm only looking at this from a chart perspective. If indeed prices break above this top end, what normally happens is they'll break over, they'll come back and reconfirm the purple line in this case, and then they'll rally higher. If they break below, and I apologize, I don't have a very good example of that for you to look at, usually that means the prices are going to plunge. It's a little bit unusual to see it break over here. Usually it comes in and gets shallow and then rolls down. So from the moment, this looks fairly bullish for Apple. Again, they're reporting earnings on Tuesday, so we'll find out what the real story is with them. But you can see here's a very defined pattern. Now, if Apple does roll over and head down, it's a bad signal for the broad market, because Apple is one of the 4 largest companies that effectively is the stock market right now. How do we know that? Well, we can go over here and we can overlay the S&P 500, and we can go way back, and you can see Apple is effectively the market. You have Apple, Microsoft, Facebook, Google, I think. There's like 4 companies that are pretty much driving the market of this. Oh, Amazon, definitely. I don't think it's Google. I think it's Amazon. In fact, we can just click on the Amazon chart, and there you go. We can look at Google and say, sort of, but not quite as much. So anyways, so here you see this symmetrical triangle that's been forming starting back in late 2018. If it breaks down, the way you're supposed to figure it out is you measure from down here. Actually, you're supposed to extend the purple line down to where it matches this point here. So that would be roughly somewhere down here. You take that distance and subtract it from where it breaks down, and that's how low it's going to go. And this is a very large symmetrical triangle, which suggests that Apple stock could be trading somewhere down into the 90s, low 100s, which, again, I don't want to go on record saying that it is going to. I'm just going to tell you what charting principles tell you. It does not mean it will actually happen. For all we know, this whole form will be invalidated. But if it does break down, you have an idea where it's going. Now let's take a look at crude oil, because we can zoom in a little bit on it. Now, let me zoom back out just momentarily. And you can see there is the symmetrical triangle, and I will make these purple, and actually let's make it lighter purple so you can see it, and we'll make this one a little darker so you can see it as well. And so here's the purple lines. Again, very clear symmetrical triangle, and you can see how crude oil did not meet the line up here. That is looking very, very bearish for crude oil. Now, how would we measure crude oil? Well, I think we did this maybe a week or so ago, but let's take 42 to 76. That is what, about $35. Let's just round it to 33 just for simple math. So let's say it crosses the purple line somewhere between 53 and 54. This chart pattern is suggesting that oil could get down to $20 a barrel. Again, I do not want to go on record saying it will. For all we know, this will be invalidated. It is not real, but this is just how you measure these patterns. So the fact that oil is declining here, and if we look at the inventory this week, what we saw was a large crude oil draw as of today of 10 million barrels. That's normally bullish. Normally. But what happens when you see a large crude draw, you want to look at gasoline, which obviously goes in cars, right? And distillates. Now, where do you see distillates? Think airplanes, large, things like that use a different grade of refined products. So they fall under distillates. Probably ships, planes, things like that. So when you see a $10 million $10 million barrel crude oil draw, what the market is looking for is a large draw of gasoline and distillates. And when you see all of them fall, what it tells you is there is an overwhelming demand, there is not enough supply, and it's drawing everything down. When you see a large crude draw, but you do not see, or in this case, a very minor gasoline draw, and I think distillates had a slight build, or those two could be reversed either way, but virtually no change. There's less than 1 million barrels each, so virtually no change. What it's telling you is the shutdown from Hurricane Barry, when all the refiners in the Gulf had to shut, and the offshore plants had to shut down for the storm. What it said is the economy really didn't draw hardly any gasoline down or distillates. That's what it's saying. And the market looked at that and says, wait a minute. We had this big crude drop because production was idled temporarily. The economy should have drained down a whole bunch of gas and distillates, and it didn't. So that's why we saw oil go down today. Part of the reason is because the market thinks now, well, next week when production is back to normal, or maybe the week after, somewhere within probably a week or two, it'll be normalized. That means that we should see gas and distillate builds, and that's not bullish for oil, which hence takes us right back to this charting pattern and suggests that at some point in the very, very near future, crude oil is going to break down here and see a heavy amount of selling. From an investment standpoint, when you see crude selling and you see the bonds are still sitting right on the launch pad, ready to break out here and take off, it tells you very, very easily that the stock market's got a big problem, because when bonds rally and crude oil crumbles, stocks will go right down with crude oil. I'm Steve Van Metre. Thanks for watching. We'll see you Friday for a more comprehensive weekly economic update. Bye now.